Hey everyone, John here from the Ternullo team at Leading Edge Real Estate. I'm here today with local mortgage expert, John Maroney. How you doing, John?
Doing awesome. How are you?
Good. So we've been getting this question from buyers lately.
Yeah.
They're looking to buy a home, but they're currently saving money for their down payment. They want to get 20% down to avoid PMI.
Okay.
So wanted to ask you a couple questions.
Absolutely.
About PMI.
Yeah, it comes up all the time.
First off, what is PMI?
Well, PMI, it stands for Private Mortgage Insurance. What that means, a little quick history, back up to like around the mid-1950s, everybody had to put 20% down. That was the requirement. Then a company called MGIC, Mortgage Guaranteed Insurance Company, said, hey, to the lenders, we'll insure the first 20%. Let's say if the borrower went into foreclosure and then they had to go to an auction, that 20% would be covered by the mortgage company. Let's say the house was bought for, or the loan was $100,000, and then when they went to the auction, they only got $80,000 for the house. That $20,000 deficit, the bank wouldn't be out that. The mortgage insurance company would pay that. Right. So MGIC said, we'll insure that. So then that enabled people to stop putting down less than 20%. And it was tremendous for this country because the home ownership back in the 50s, owner-occupied, was like around 38%. Now it's in the 60s, the mid-60s. And that attributes to the fact that people don't have to put down the 20%. Okay. And I know everybody's fixated on the 20% no PMI, and it's like this evil thing. People feel.
Why does everyone hate PMI?
I think what happened was over the years, people were so used to getting accustomed to putting very little money down and not realizing that it was the PMI that was enabling them to do that. And they were looking at it as an extra bill. Like, why should I have to pay this PMI?
Sure.
So really what the PMI does is it gives someone leverage. Like put another way, let's say if I said, okay, let's say someone had saved 5% down on a $630,000 home. That's like $35,000. And right now, a one-bedroom apartment at the Seaport, someone's paying $3,500 a month. So if I said to you, how would you like to, with the $35,000, just use that for a down payment, with the same exact monthly payment that you're paying right now, you get to own a house, and 5 years from now, with the same money that you're spending right now, you'll have an extra $150,000 net worth. Would you take that deal?
Sure.
There's one problem with that. That part of the money you're paying is PMI. So what?
So can you ever cancel PMI?
Well, yeah, exactly. So how I came up with this $150,000 net worth is this. So when let's say someone paid $635 for the house, and let's just say the house just appreciated 3% per year.
Sure.
So in 5 years, that house would be worth $730,000. Not to mention the mortgage itself, principal balance, would be paid down another $50,000. Now this is with the money that they're already spending. Now let's say you think about this, they're already spending $3,500 a month. They claim they could save. Well, now that they're in this house, why not that money that they're saving, whether it's $500 or $600, save for something else. Save for kids' college. Heck, you can even save for another property, an investment property. 5 years from now, instead of putting the money down towards the house you're going to live in, now you get an investment property. Or you can put that into the to the stock market.
Sure,
sure. It's your choice. So it's really what it comes down to. It's leverage. And so when I say this, forget about what it is. Let's focus on what it's doing for you, period. And then it's just, that people still see the PMI and they're like, I hate the PMI. Well, guess what? The example I just gave you, in 5 years, you can get rid of the PMI.
And how does that work? How do you get rid of it?
A couple different ways. So if they just simply made the mortgage payments and the house appreciated, they can call the lender in like 2 years and say, I want to get rid of the PMI. They pay for an appraisal, and if there's 20 or 25%, depending on the lender, the PMI will go away automatically. Let's say the house doesn't appreciate at all, and they just continue to make their payments. They put 5% down. In 9 years, the loan to value will be 78%. And under the Principal Reduction Act, the PMI has to go away automatically.
I see. Okay.
So worst case, they're paying the PMI for 9 years. And again, this is the money they're already spending.
Sure.
I keep stressing that because they're living, let's say, why that's important is, let's say someone is, again, living in that $3,500 a month they're renting, and they can't save. Well, guess what? Get into this thing, pay the PMI, and then 5 years from now you have an extra $100,000, $150,000 leverage, where if you decided you were going to try to save, but you were never going to save, you'd still be in that apartment, and you'd be $150,000 less wealthy, if you will.
And it seems like an uphill battle, because if you're saving for 20% now,
yeah,
by the time you get to that 20%, that 20% is now greater because of home
so,
appreciation as
well.
well.
So if the home appreciates $100,000, now you have to come up with an extra $20,000. Another thing I want to point out too. Let's say someone wanted to wait 5 years, okay? Which, this is amazing. I just did this. Right now the rates are 4.125. 6 months ago they were 5%. So the difference in that monthly payment is $315 a month. The PMI on that's only like $200 a month. So let's say they waited 5 years, okay, to avoid, they're going to save and they want to avoid the PMI. And let's say the rates end up at 5%, 5 years from now. That could happen. We just saw it.
Sure.
So the PMI that they were about to avoid 5 years from now they got that same payment, but it's called something else. It's called a higher interest rate.
Yep.
So they really didn't save anything. They waited 5 years. They lost out on $150,000 of free money in their pocket, through the appreciation and principal reduction, just because they hate this term called PMI. Now, if someone really hates wants to get rid of PMI completely, let's say you can also buy out the PMI. So in this case here, on a $603,000 mortgage, I actually did this for this client of mine. They had great credit. They actually had their credit score was 780. So for just under $6,000, you can buy out the PMI completely. It's
really?
one lump sum, and you can even have the seller pay it. So when you make the offer, you just say seller pay $6,000 towards closing costs.
Sure.
And they're going to get the same rate like everyone else, and they're out of the PMI.
Wow, that's terrific.
Yeah.
So for a buyer looking to buy a home in today's market,
yep,
if they don't have 20%,
right?
What is the minimum amount that a buyer can have?
So we have programs as low as 3% down. If someone's a veteran, there's no money down program. There are other, I know Mass Housing has that program with no money down. It's like a first and a second, but there is PMI in that.
Sure.
They could do that. Another thing that they could do is borrow from their 401k. Now, I know when I say that, all the financial planners get up in arms saying, oh, they're going to take all this money out of the market. Well, I did a little quick analysis on that. Let's say they won 5% to put down, and the same example here. They took out $35,000 out of the 401k. And so let's say at the end of 1 year, the home is going to appreciate like $18,000. They're going to pay down their principal by about $10,000. So they just picked up $28,000.
Yep.
Now that $35,000, let's say the stock market went up 20% that year. So they would have missed out on $7,000 gain, but they made up $28,000 here. So they're still ahead $21,000 if they borrowed against their 401k. And that's at 20%. That's not to mention the next year, the stock market could drop, and the houses aren't going to really drop, not around here anyways.
Sure.
And as they continue to make their mortgage payment, that next year, that principal reduction will drop another $10,000. So I'll say it one more time, with the money they're already spending. It's not like they're coming up with extra money. They're paying rent anyways.
So with mortgage payment, with the interest rates now lower than what they were a little while ago, for anyone looking to buy a house, they even if they're thinking about saving up to 20%,
right,
they should probably contact you first.
Yeah, and I will say that now that the rates are low, even though you're paying PMI, you're locking into the low rate. The PMI is not forever. It's your choice. So if someone says they want to save for money, why not lock in to this, 4.125 and make extra payments towards the mortgage? Again, if they were going to plan on saving 20%, well, under the principal reduction, once they hit 22%, the PMI goes away anyways.
Sure.
They just told them that they plan on saving 20% anyway, so they have the means of doing that. And the monthly payments are going to be the same as what they're paying for rent anyways, and they get to own a home. They get to paint at any color.
Well, that's just it too. I think, sometimes a lot of people concentrate on the financial aspect, which is very important. But obviously, a lot of home buyers need a place to live, and they want to be happy where they live too, and that's something.
You got to love where you live.
Sure.
Absolutely. I mean, I always said that. You got to love where you live. If you love what you do for a living and you love where you live, that makes for a good life.
So for anyone watching, how can someone get in touch with you?
Well, you can just Google me, John Moroni, JohnMarroni, and you'll see all my contact information there.
Terrific. And if you are planning a move in the suburbs north of Boston, feel free to give me a call, 617-275-3379. And to learn more, visit TernulloRealEstate.com.